Welcome, everyone. Thank you for joining us for today's webinar. My name is Fabio Bergamo, and I'm the COO at JLP Asset Management. JLP is a global investment firm focused on public real estate securities. Our firm has a distinguished active management approach seeking to exploit valuation disparities across geographies and sectors. Today, we will discuss with Jim Rehlaender, JLP's Global CIO, his views about the trends impacting the global real estate market. Mr. Rehlaender has decades of experience in the real estate industry and has been managing global real estate securities portfolios for over 20 years. Just a little housekeeping before we get started. If you have any questions during the presentation, please type them into the question box in your Zoom control panel. I'll bring that up during the presentation, and we also have time for questions at the end. We have a full agenda today, so without further ado, good evening, Jim. And to kick off things, let's talk about the number one question we get from investors. In your view, what are the impacts of inflation in real estate?
Well, thanks, Fabio. And yeah, inflation's on everybody's mind, including the Fed chairman yesterday, and that's all they had to talk about. Interesting story, though. As we look at inflation, certainly it's a focal point for us now in the U.S. and for you guys in Brazil, but you know, it's not quite the same thing in other markets. But in general, what we have found over decades is that inflation is a positive for real estate, as many contracts have inflationary provisions in the contracts, rental contracts. And we also see that when you have inflation, typically you also have growth coming with that. The only time that there can be a problem is when you've got excess supply that's built up, as we saw in 08, 09. But otherwise, real estate does quite well in inflationary periods. So good place to put your money when you're worried about inflation but also with growth. Now, yeah, go ahead.
No, and very interesting. We collect a few anecdotes from the team globally of things that we've been seeing in the market, right? Such as home prices up 20% on the last 4 months, landlords pushing rents by 15% in Q3, self-storage companies quoting rents at 30%. So you do have seen, right, clear price growth in several of those sectors. Right?
Yeah, and I have to tell you, I've been more surprised than I think most about the price or rental rate progression. Just talking with some people in the industrial sector, the rental growth has been phenomenal, and that's really been driven by a number of things we'll talk about later. But these are rent numbers that are far, obviously, ahead of inflation, and we're seeing that. But it varies according to property type as well. So we have in some markets we've actually had things slow down in the office market sector. And it's quite variable depending on the business. That's what, for us, makes it kind of intriguing, because you're looking at a variety of different rates of growth and performance levels around the world. Hot ticket right now is self-storage, which we'll talk about later, and industrial. And those that are dragging behind are retail and office and hotels.
Interesting. So taking that link about sector specifics, Jim, we'll kick off with talking about office, right? And the whole discussion about working from home, it's still unclear, right, what the new normal will be in those sectors, right? And in parallel to that, we've been seeing different levels of return to work across the different geographies. Where are you seeing the demand in the property type?
Well, yeah, and as you look at the chart below, it's showing the physical occupancy. So the work from home thing is still going on, and return to office is still lagging in some markets. But in Japan, it's pretty much up to 100%, and frankly, in most of the Asian markets, and And I think a lot of people are starting to get called back to work. Couple of interesting developments here, though, and this really has come out recently. The companies are really anxious to get their employees back to work. And so they want to locate in facilities that have great amenity packages, and they're willing to pay more for rent than, frankly, I would have thought they would have. And their explanation is, look, rent's not that big a deal. If I can bring my people back, I can create a better environment. Now, that's good news for new buildings and buildings that can handle that. For older buildings with smaller floor plates and aren't as adaptable, or HVAC systems that don't bring in a lot of fresh air, you could be in trouble. So it's an interesting bifurcation of the market. If it's a quality building and it's adaptable, it's attracting tenants and getting really good rates. And I think the greatest example for many of those of you who know the New York market, there's a big building right next to Grand Central called One Vanderbilt. And I was skeptical as to how well that would lease, because they were targeting $150 a square foot, which is quite high for New York. And it's already at 90% leased, and rents are well in the high end of the expectations. So interesting developments, Fabio, and I've been around the block for a while, and I haven't really seen that kind of thing happen.
Interesting, Jim. And then moving to a sector that everyone have mixed feelings, right? I think COVID accelerated some trends that we already seen in some of those markets, and e-commerce being one of them, right? And the retail sector has been very impacted during the pandemic. What's your take now for the sector, and what you were seeing, particularly, right? We see the US and the UK with one kind of dynamic, continental Europe a bit different. I'll let you talk a bit more about that.
Yeah, sure. Well, real estate is a localized market. In the US, we had way too much retail built in the first place, but we also had rents that were getting a little too high for most retailers to handle. And then add to that the COVID problem and e-commerce penetration, and it hit everybody really hard. And so just to give you a rough idea of numbers, when retailers are paying roughly 12 to 15% of sales in rent, they're okay with that. They do actually quite well. But we were getting up in the 20s. And so there was going to be some challenges anyway, regardless of COVID. But then, of course, that changed everything. And what I think is fascinating is to see how COVID sort of turned everything upside down. There was a mass move to the cities, and now there's the move away from the cities. So city retail got crushed, and that's true in a lot of markets around the world. Now that we have people coming back to work, that looks like a really interesting opportunity. But in the meantime, landlords have cut rents. I think things are getting much more reasonable from a cost perspective. But then the retailers have also had to up their game. And in fact, now we're having a lot of retailers adapt to some sort of an e-commerce model. So our view is that, the stocks have been trading anywhere from 30 to 50% below fair value, and that's probably too much. And if everybody kind of comes together and people do start going back to the stores, which we do think will happen just to get out of the house, and the retailers sharpen their game, this could be a very interesting opportunity. And if you look at on the left, you start to see sales come up. We just got the data actually from the UK, where the footfall, people coming into the stores, is roughly where it was in 2019. And some of the shopping centers were reporting sales that aren't that far off. Now that's sort of US, Europe. Asia has already been moving in that direction. So we've seen malls do really well in Asia, but not so much in the US. So again, highly differentiated market globally.
And on the flip side of the e-commerce impact, we've seen the growth, right, and the high occupancy levels in logistics and industrials, right? Those are two sectors that not only benefit from the e-commerce trend, but they have been fueled by the supply chain bottlenecks that we've been seeing in the recent months, right? Self-storage being benefited by the migration, right, in some of the regions in the US, and the B2B use in Europe, right? And it became probably like one of the top favorites for many investors, right? What is it too expensive now? Is there still value to get from those sectors, Jim? What do you think?
Well, that's been the fascinating development, is to watch the growth of warehouse and logistics facilities, where this was always sort of a laggard class. You always used to get 9 to 12% kind of cash returns, and you had some tenant risk. And now it's become, as you can see on the chart, one of the more expensive and certainly the lowest yield property type. In fact, in London right now, the industrial space, especially Southeast, is trading at around 2 to 2.5% yields, which is pretty amazing. Checking with all the companies have just reported here in the US and also elsewhere in the world, numbers still look strong, and the penetration continues. And we would expect, certainly in Europe and Asia, where it's less penetrated in the US, for that trend to continue. And again, we're seeing rental growth that is pretty phenomenal. And from every indication we get, there's even more to come. So just talking with our head of the US today, rents could double, but they won't, because landlords will kind of gradually work that through, and that's a pretty big shock. And then there'd be no increase after that. But these kind of numbers, again, I haven't seen ever in my lifetime. And in London right now, we're seeing, or the UK market Southeast, rental rates, or actually values per square foot, that aren't that far away from office buildings, which again is unprecedented. So we continue to see this happen. We think also we're mindful of the fact values are pretty stretched or pretty high, but we think there will be some effort to find alternatives. And one of them, in fact, is self-storage, which is interesting. This is all new to me, frankly. Self-storage, you left college, you had a few extra things, or you moved your house and you threw these in a box and they stay there forever. Well, what we're finding is a lot of these storage facilities are located in cities, in locations close to your client base. So retailers and others are using them as sort of last mile delivery. And that's particularly prevalent in Europe, where it's really hard to get any new construction. So when suddenly you're looking at a warehouse, or rather a storage facility, where you kind of knew what rents would be and the growth rates, now there's a whole new dynamic that's changed the perspective, and storage has been really one of the top performers for the last 12 months in the public markets.
Moving to residential, Jim, it's a sector that historically is very consistent, right? High occupancy rates, high collections, very, very large sector in the US, right? Especially in the US. We read a lot about the increase in sales prices, right, in houses, and then some people moving to rent. If you could talk a bit more about the US and then the global trend that you also been seeing, right, on more the build to rent type of residential.
Yeah, sure. I mean, if we look back over the last, since the financial crisis, 08, 09, we really weren't adding much home supply to the marketplace, and even multifamily. So, people were reticent to develop. It was slow in happening. And yet the demand was growing apace. So you really had, a major collision here, where you had a shortage developing, and it's been developing for quite a while. And as a result, we've seen home prices rise pretty steeply, and then you've had low mortgage rates to fuel that fire as well. And so suddenly it's not so easy to A, find a house, and B, pay for it and be able to afford it. And what's developed in that process has been all different forms of rental housing. So you have manufactured homes, which some people think are trailer parks. It's a lot nicer than that, but it's a manufactured home coming out of a factory. You have single family rental, which has really developed into its own category, where people of moderate incomes want to be near a good school system and need a house, but apartment's too small. And so this has grown into a phenomenally large industry where you have private and public markets participating. Again, something that didn't really exist in any sort of size or substance 10 years ago. So you've got, and there are a variety of rental kind of things in between. And I think the big point here is that while home ownership remains popular in the US, and I'll talk about other markets as well, it's suddenly the stigma of rental seems like, to me anyway, it's gone. So now all of a sudden you have a wide variety of choices to play the housing game, as opposed to just buying home builders and playing the interest rate game, which is really all that is, and then worrying about excess supply. So it gives us great exposure and great potential to get exposure through a variety of different markets. Now, the most recent development, and this has been within the last couple of years, has been rental housing expanding globally. And I guess you could say the US is sort of the starter of many trends. And in this case, we've got UK, they call it build to rent developments that are specifically for rental. So it again, it's not something where you built a condo project and it didn't sell, so you're renting. These are purpose built. These are specifically built for rental. And China is developing that as well because they've got a fair amount of inventory they need to work down. But the concept, we think, is growing globally. And even in markets where people always bought houses like Spain because Franco confiscated all their property many years ago, they haven't forgotten it. Even they're starting to consider rental. So we think this is a great business to get into, and the challenge for us is finding good operators in these different markets, but we expect this will continue to expand.
Jim, are you positive in all types of because as you mentioned, right, you have student housing, senior living, you're going to have single families, multifamilies, manufactured homes. What's your view across those different types, right? And do they exist in all regions, or these are like the US is more developed and you see all these differences? How does that?
That's a key question for us. Now, student housing is developing in other markets in the world. And it's one of the more challenging to figure out because in student housing in London, it's dependent on foreign students more than anything, and different customs as to housing. But in terms of single family rental, haven't seen that yet outside the US develop, but just more apartment type concept, multifamily type concepts around the world. Yeah, we're bullish on it because we still think home prices will remain elevated, and there's really nothing to say that will change because supply still is constrained and demand is strong. And we also see, again, this stigma of ownership versus rental going away. And so now you're looking at it from a pure economic perspective. Do I really want to put up let's say a couple $100,000 deposit to buy a house, or do I forget that and maybe pay a little bit more in rent and get exactly what I want in a good neighborhood? So it's a very different dynamic, and we'll see how this develops over time. But right now, there's a lot of good value for money there.
The last sector we are going to cover today is probably the one that also it was one of the least preferred ones during these last 18 months, right? Lodging, hotels have been hard hit during the pandemic. And now the recovery has been highly dependent, right, on the reopening of the economies. And we've been seeing a pretty substantial difference, right, in players that are more business dependent and others are leisure dependent, right, the resorts and so forth and so on. Where would you position your money if you had to invest in lodging, Jim?
Well, I like the lodging business, but I've also done a lot of hotel workouts, so I know there can be another side of that coin. Um, we have seen really good growth for domestically oriented hotels, and in the U.S., in Asia, if you're catering to a local crowd, not a business crowd, but just a local crowd, the staycation concept. And in Hong Kong, it's actually that goes to restaurants. Eatcations. I know that's a new one for me, but that's just come out. So you do see that sort of thing developing, and we think that'll continue. Now, the interesting play though is as more of these countries open up to travel, and it's got to happen. I mean, we're just we go through fits and starts, but it's going to happen. So we like getting positioned in some of those hotels, and understandably, the supply's been cut back. It's not so easy to get hotel financing anyway. And so we think there's a lot of good growth potential. In New York, we've had a lot of hotels just get shut down and may not come back. The challenge in the business is actually getting labor. And so you might have great demand for your product, but you can't operate it at full capacity. And there are a number of great examples of that. There's the actually Four Seasons Hotel in Napa just got sold for a 2.1 million a room, second highest in the US. And interesting story there, it hasn't even been open more than a month. And it's running at about a third capacity because they don't have labor to service the rooms, and yet it sells for that kind of price. So there's an interesting dynamic here. We see a lot of private capital moving into the area to take advantage of this in anticipation of the recovery going forward. And I think that's pretty smart money. In Asia, we like the hotel business because food and beverage is really strong. People go to the hotels for the restaurants, not just the rooms. And that is a big moneymaker. So we've always liked that kind of business. And they're trading right around where they were in the 08, 09 financial crisis. So lots of good upside. And, we got to weather the storms of lockdowns. But I think we're all of the view that it's got to end at some point and people will start traveling. And certainly the leisure travel has been great and resorts are benefiting from that. No question about that.
Jim, one last point that is more holistic across the entire real estate market, right? It's about future supply, right? Can you explain to the audience why you think there are dynamics today that are, as we put here in the slide, impending this future supply, right? What are the drivers to give us confidence that there won't be an oversupply in the short term, like especially in sectors such as industrial logistics, right, and residential, as you mentioned during the webinar?
I think there's some structural reasons, and I think there are some psychological. I do believe people still remember when we overbuilt like crazy, so there's a little bit of carefulness there in terms of lending and availability of capital. But I think right now we're running into other issues like labor, as we mentioned, availability of labor. Land costs have gone up a lot over the last few years, so it makes projects less feasible. And then the other thing is let's take office, for example. You're not sure how fast people come back to work. So how much space do I really need? The tenant can't tell you that. And if you're going to do a new development, you kind of need to have a handle on that. So I think that'll slow the whole process down. And then we also have out there ESG considerations and environmental in particular and impacts. So all that's kind of combining to slow the pace of development. Normally we have a huge supply response. When you look at logistics right now or industrial, and you're getting a 2 cap rate in London, you would expect massive construction. Well, they don't want to see an industrial warehouse building in the neighborhood. It's the whole NIMBYism thing. So it's not that easy to get approvals. So you have some sort of natural or local barriers. And then you have construction cost barriers and labor availability barriers. and then just general uncertainty about future demand. So all that combines, and that's why I get even more excited about this, because it reminds me of, it's not like 08, 09 where we built way too much stuff. And then we had to have the economy bail us out. But now we have I think, growing demand, and we have very little space being added to the markets. And there are very few cases where we have, supply angst. Japan is one of them. Tokyo, they've got too many buildings going up, but yet, we're not paying for that in the public market with the property companies at 30% discounts. So I think we're covered. But otherwise, Singapore is another good example where they're raising rents right now in office space, even though they're still not allowed to go back to the office. So, very interesting dynamics that we frankly, I haven't seen before, because as I say, it's usually boom and bust in real estate. You get strong demand, you build too many buildings, you have a slowdown, and then you're stuck. But not this time around.
And Jim, when you think about a limited supply, right, future supply in the short to mid-term, how does that impact the listed side of real estate, right? The incumbents, like the existing firms, versus maybe players that are building their portfolios, kind of following trends or trying to start from scratch.
Well, I think, what we see is a lot of private equity capital that is looking for a home and trying to buy it in anticipation of that same thing I just described. They look at it and say, hey, this is a pretty safe bet for the next 3 years. The public markets are still kind of pricing in uncertainty, worries about interest rates and, who knows what else, but they're not trading at par, basically. And so we are seeing some take private situations, and we'll probably see more of that, or consolidation in the public side, because valuations aren't near the actual underlying values of the real estate. So I think that's going to continue until we see those two kind of merge.
Excellent. Thank you, Jim. So that was the agenda and the items we had. So let's pause here and see if we have questions from the participants. Just a reminder, if you want to send your question, you can type in the question box in your control panel. Let's see if we get any questions here. It looks like the presentation was very complete, Jim. We're not getting any questions, so we'll wait.
It's late in the day, and for some people, really late. So
we can wait a few more seconds, and if we don't get any questions, we can wrap it up. We got one question here from Vitor. Jim, would you kindly elaborate on how you see this work from home experience evolving over time? He mentioned we see a lot of rent collection, but actual usage is pretty low, right? The physical occupancy versus collections, right? And what's your view moving forward?
Well, the good news is rent collections they're basically where they were pre-COVID. So you don't have any worry from a cash flow perspective. It's tough though, and let's stay with office for the moment. Think about an office building that was full and all the restaurants surrounding it, all the services that aren't being used. So that's creating a real depression in some of these major city office markets. That's the one thing that we'd like to see come back. But I think what's going to happen, and well, we know what's happening already in the US, in the financial services area, people are being ordered back to work. And, they may be told in a nice way, like, gee, it'd be nice to see you back. But everybody knows that means your bonus is dependent on that. So they're going to show. In San Francisco is a tougher one because the more tech-oriented businesses there have functioned really well working from home. And so there we see the physical occupancy and San Francisco is still dragging. I think the latest numbers are in the 20%, 20 to 30% range. New York was in that area and is probably getting closer to 40 to 50%. I think by first quarter, we're going to see a lot of people come back to work unless there's something else out there that hits us. But in terms of rent, that's not been a problem. Rent collection. The bigger issue is how much can you increase rents down the road, and what sort of tenant demands you'll have. And I think our basic view is that you're going to need more sort of flex space, open space, but with everyone having maybe smaller or fewer offices. So net, you'll use the same amount of space, but have fewer people occupying it. The other interesting development, this just happened within the past few weeks, tenants are actually coming into landlords looking for longer terms at these lower rent rates. And so now you have the tension of the landlord saying, well, God, I don't want to lose you, but I also don't want to sign up for 10 years at this low rate. So that's new, and that I would expect to continue.
And Jim, we always discuss as well about the views of some buildings will have demand and others will suffer more with demand, right? When you're talking about quality of the building, and location of that asset. Could you explore a bit more about that kind of these two sides of one market, right? That will have very different, play a very different dynamic, right?
Yeah, and that's playing out right now. If you've got a B quality building with small floor plates, lots of columns, so you can't really have an open, free flow of people. So they're just being put in too close together. Plus, they may have ventilation systems that can't recirculate air enough and have to be retrofitted. And so I think the average tenant, when they're looking around for space, is, yeah, I can save a lot of money, but my employees won't want to come back. And so, that for the moment is the deterrent. If there's, either a medical breakthrough or maybe attitudes change, maybe that will go away. But for the time being, it's looking a little scary if you've got a B quality office building that is in need of some pretty heavy renovation in order to meet the demands of the current tenants.
Great, thank you, Jim. We got two questions here about retail / shopping malls, more specific, Jim. One is asking if the shopping malls are trying to repurpose as destination venues, such as like eating, cinema, etc., to bring customers back. And then the second one is more your view on the rents for each subsector, right? Maybe your view in terms of when you talk about malls or street stores and strip centers, right? And the different types of us.
Sure. Well, actually, there's news today that a mall's converting to an apartment complex. So, we'll see a fair amount of that happen, or converting to a warehouse space. But in terms of tenant roster, as one landlord said to me, I can only have so many Chinese restaurants. There's only so much restaurant business you can take, and I think that adds a lot of risk. So they're trying to figure out what else they can do to bring people in. We've seen this long ago in Japan. You'll have doctors' offices. You have the post office will be in the mall. So anything they can do, but also creating more entertainment, more reasons to come to a center, and more reason to stay at the center. And the retailers have really got up their game too. So you'll have some click and collect, which will get people in the store. So you order online, you go pick it up, and maybe you wander around and buy something else. But the whole concept in many markets, especially the US where we have so much retail, they're just going to have to rethink the malls. And yet you go to the Asian malls for a long time have already had lots of food and beverage and entertainment anyway, no department stores. So they're actually doing quite well. So I think that's really not going to be, everything's just being re-looked at. And in some cases, the mall gets torn down. And in other cases, gets completely redone, redeveloped. But either way, it's going to take a ton of capital, and some owners will be able to do it and some won't. As far as rents are concerned, that's where you're going to struggle. You know, we've gone through a period of sales percentage rents, turnover-based rents, as the Brits would say. And, you know, you sell it, then you got to pay me some rent. Otherwise, no. And then the other tension is if it's click and collect and I ordered it online, who gets credit for the sale or how's that done? So that's all being still discussed. But I think the net is rents in shopping centers have come down a lot, and they're probably going to stay down, or they're not going to be able to have a rent roll until we stabilize, and then people start coming out to the malls, and then you see more activity. And I do think that will happen. It just won't happen for every mall. And we definitely see it in Asia. We see more of that in Europe, where there aren't as many malls anyway. So that's still happening.
And how does that compare with the other types of retail?
Yes. Well, yeah, I think what's been crushed is anything in the urban areas. So retail on all the prominent streets in the major cities has been hit very hard, with a few exceptions. I think Tokyo is probably still doing okay. But that's been the tough area, and they've taken a lot of supply out. If you go to New York now, you see a lot of boarded up storefronts, and rents have to have adjusted. Now, when people come back to work, that's going to be a different story, and we'll see how that develops. In out of town centers, or I should say, we call them strip centers, grocery anchored. They're doing really well, and they're killing it, and their cap rates are fallen dramatically. So great value for money there. Just got reports from Tanger, an outlet operator here. Rents are pretty substantially above 2019, sales rather. And, so that's a surprise. But again, it's out of town. You don't have people congregating, so you don't worry as much about COVID. And, those guys are doing fine. So I think, and then suburban markets are doing a bit better than urban markets for the moment. So we'll see how that transition goes. But I think all in all, it's a gradual recovery for the cities, and the suburbs are already doing pretty well.
Thank you, Jim. One other question here. We heard a lot about New York is over, and now everyone is moving to the Sun Belt, and everyone is moving to Miami. And we start seeing some good news, right, about some large firm like Google buying a new office building there, and a bit of the recovery. What's your take in New York specifically?
Well, we have a new mayor who is more, well, I like what he says. Let's put it that way. He's more law and order. We've got some issues in New York, but you're right. Google just plunked down $2 billion for basically a bus terminal. They're going to develop that area. So I think certain businesses are going to, they want to be in New York, and I think that's certainly advertising, social media, the financial services businesses not going to go away, but we do know of quite a few people who've relocated. It's just when you look at who's gone to Florida, it's mainly the big guys with the big paychecks that will be whacked pretty hard by taxes, and already are. But the sense I'm getting is that it's not much more than that, and the numbers are actually quite small for those who've actually left New York. So I think New York's a great bet. I can tell you for sure, if you're trying to buy a building, it's a good quality building, the cap rates are not going to be exciting to you. So buy your public company that's trading at 30% below that, like Boston Properties, and you're looking at a cost per square foot that's right now about a third of replacement cost. And, I like those dynamics.
One sector that we did not cover today, and we got a question, is about the healthcare sector, right? We do have a few bets in the portfolio. Can you give your view on the healthcare?
Yeah, and healthcare, and I'll stay with the U.S. because that's really where it's most developed, and outside the U.S. it's quite different. So, but in the U.S., the way it's structured is you have a healthcare operator who's essentially employed by the REIT, kind of like a hotel management company. And for a long time, the rents have been barely covered by their revenues, and so things were pretty stretched. And then you throw COVID at it, and all of a sudden these guys can't pay the rent because their coverage ratios are too low. So the whole market sort of repriced, and I'm really talking senior housing mainly, not medical office buildings, which is another category. But in any event, I think the whole market's kind of repriced, and frankly, that's what got us interested, is when it went through that repricing, and we started to see COVID's impact lessen, that valuations look more intriguing. But the basic structure of the business was, I think, headed for a fall, and it took COVID to really drive it home.
Thank you, Jim. So I think with that, we would like to thank you everyone for joining us. We appreciate you being here, and hope to see you again soon. Thank you.
Thanks, folks.